morning, everybody. My name is Maggie Incandela. I'm sitting here with Michael Oppenheim. Just for a little bit of reference, my background is in banking. I was a commercial lender and then a chief credit officer, the person who approved loans at a bank for about 30 years. I left banking 5 years ago. So if any of you are listening and think I sound like I'm about 25, I promise you I'm not. And in the last 5 years, I've spent a lot of time with the SBDC helping businesses get access to capital.
And my name is Michael Oppenheim. My background includes 13 years as a senior executive at GE Capital, and then as one of the business leaders for one of Aramark's businesses. I've also been a CEO of a small business headed by a venture capital firm. I've been with the SBDC for 6 years, also assisting many people with loans for not only startups, but for existing businesses to expand their business.
So the purpose of our presentation today is to address the items that become the biggest issues with companies that are trying to gain access to capital. I know for a lot of people, we hear on a regular basis at the SBDC that they're uncomfortable talking to the banks. They don't feel like they speak the same language. They're not sure what the banks are looking for. And so Michael is the one who came up with this idea, which was a great idea, to try to explain to the community from a financial institution aspect how you can best get prepared for getting that SBA loan. Or, you know, the same rules and approaches would apply also to a conventional loan. That is a loan that does not have an SBA guarantee. But today we're going to focus on SBA loans specifically.
And one of the things is we're hoping to debunk a lot of myths that are out there about obtaining loans and obtaining capital. And one of the ones where a lot of people think the SBA actually has money and the SBA lends the money. The fact of the matter is they actually underwrite banks that are approved to process SBA loans.
Okay, so let's get started. Okay, so our first slide, we're going to just start with the slides and thank God or whatever you believe in, that Jairo's here to help us out with this technical issues. So in obtaining capital, this slide is just talking about some general reasons that any of one of you on this line would be looking to obtain capital. And then the perceived risk pendulum from the approver side. So from the bank, financial institution, and the SBA, because the SBA, as Michael appropriately points out, they don't make the loans directly. They guarantee the bank's loan. So that minimizes the risk for the bank, but it is not a direct loan from you to from the SBA. So on the perceived risk pendulum side, the reason we are showing you this is so that you can gain an understanding for how banks look at risk. And this will change depending on where we are in the economy. If we're on the upside of a high growth economy, or we're on you know, towards the top and looking to unfortunately a downturn, which tends to happen, right, because our economy is cyclical. So for startup loans, just from a definitional standpoint, a startup is any business that has been in business for less than 2 full operating years, so 24-month period. They are perceived as having the highest risk because there is not a track record. There's not a track record of seasoning and navigating through different economic cycles. They tend to have less collateral. SBA is not a collateral lender, so that's why startup loans tend to be moved into an SBA type process as opposed to a conventional process, because as I said, SBA is a cash flow lender. They're not a collateral lender, and they will look past that weakness in order to make that loan. Business acquisition loans also are perceived to be startup loans if you are acquiring a business and you don't already have a similar business. So for example, if you are a boat manufacturer and you're acquiring a smaller boat manufacturer because maybe they create something different, a different product line than you have, that's not going to necessarily be perceived as a startup. That's going to be more as an existing business loan and an expansion loan. So that's seen as the lower risk because you already have a balance sheet that hopefully is strong. You already have cash flow that can prove that you can absorb the expansion. The business acquisition loan, in terms of how banks look at that definition or how the SBA looks at it, is that it could be someone like Michael that decides he wants to open up his own accounting firm, and he's seen one that wants to exit that industry because they're retiring and he wants to purchase that business. That would be, even though he has a wealth of experience in that arena, it is a business acquisition loan. It's perceived as a startup because he is a new manager for that operation. And the reason for that is because there is a thing that banks perceive and that the SBA looks at, which they call transition risk. You're acquiring the business, but you might have client attrition that can be significant or it can be modest, just depending on the prior owner's role in the business. If they were the chief salesperson, if they were the primary operator, if you're thinking like an auto repair business and they were the master mechanic, the master technician, then you might have significant attrition. And so because of that, it's targeted as a startup loan. Again, there is, in a business acquisition loan, there is usually insufficient collateral associated with that, because when you buy another business, you're buying that business based on a cash flow multiple of the earnings. So what that's really saying is, if there is a business that produces $100,000 a year in free cash flow, that business owner may want to sell that business to you for $300,000 to $400,000 just based on their customer base alone, that steady cash flow. That does not have collateral. A bank can't liquidate that aspect of the business. They can certainly liquidate the equipment or any other assets you purchase if you run into trouble, but they can't liquidate anything else. So the next slide is going to talk about types of loans that we have. So the conventional loans and lines of credit, we put this information in here for you just so you have it as a comparison. This is not based on any one particular institution. It's kind of an amalgamation of what we know the banks in this area will approve. Conventional loans and lines of credit, those are bank direct loans to you. They do not have the SBA guarantee. And what we want you to see by looking at this is that equipment loans, working capital loans, real estate loans all have a faster repayment when they're conventional loans, and they have more down payment requirements. Often, depending on the size of the relationship, they may also have reporting requirements for financial statements on a regular basis. They have ratio requirements, things you have to maintain throughout the life of the loan, which don't exist in SBA loans. So there are different types of SBA loans. The most common loans are on this first slide, and those are both the express loan and just a 7A loan. Those are all done under the 7A program. The express loan is limited to $350,000. It's a 7-year loan. Typically, you have a 2-year revolving period and a 5-year full amortization. An express loan is a good type facility if you are an existing business, you're looking to expand, and you want to have a revolving credit feature and that you can use like a line of credit, but you're still in a growth mode, so you don't know how much of that you would be able to fully revolve. Again, on that conventional side, when I talk about the additional requirements. On a $350,000 line, a bank might want you to revolve that fully to zero for 30 days, a couple of times a year. With an express loan, you don't have to do that. You can revolve it. It doesn't have to go down to zero. There's not those 30-day requirements. And at the end of that 2-year period, you can term it out and not have to worry about what the bank would do to your line of credit. The most typical type of loan that we see clients need is just a 7A loan. So the 7A loan, if you think of a 7A, and on the next slide, there's some other loans, and the other one you probably most commonly have heard about is a 504. So let me just do a comparison and contrast for a second. A 504 loan is specifically only for real estate and equipment. And even when I say equipment, it's not for all equipment. It's really hard asset equipment, equipment that has a useful life that would support the loan. So 10 to 15 years useful life. If you think about it, it's more caterpillars, bulldozers, heavy equipment that has a tangible market value than say small tools and other things that you may need for a job site. The 7A program, by contrast, is what I call the soup to nuts or the umbrella program. You can finance anything under the 7A program. So it's working capital, it's that business acquisition, it's startups, it's real estate, any type of equipment, leasehold improvements, or fixtures.
And keep in mind, under the 7A program, the minimum that banks like to do loan amounts for is 100,000. A lot of them are 150,000. But when we get to the subsequent pages of different types of loans, you'll see other loans that are available that don't have that minimum threshold of $100,000 or $150,000.
I already talked about this. Oh, microloans are out there specifically. They're not all banks will make microloans. So back to what Michael was talking about, when you look at some of the banks out there, most banks have those minimum loan sizes. Some are 100,000, others are 250,000. If you are taking notes, some good banks to think about from the lower size spectrum, there's a bank called Celtic Bank, which is out in the Panhandle. There's also one, United Midwest. They really like to focus on loans that are in that 150,000 or less range. Some of the banks, the local area banks, they're in that 150,000 and up. Some will go as low as 100,000 for the 7A loan program. Microloans are the $50,000 loans. Ascension is one that will do that. There are some micro lenders out there. They've been a little quiet post-COVID. So a lot of people are still processing PPP forgiveness, and they're getting their money back from that. So I imagine as all of that flushes out in the system, we'll see more activity in the microloan program. So again, here's the SBA 7A loan program, a snapshot of it. We talked about it a minute ago. The thing I will point out is the maximum maturities for real estate, 25 years, equipment and working capital is 10 years. You do not have to have separate notes for the different type of collateral. You can have one big note with all of it. If you're buying your real estate in the business name, they will do what's called a blended maturity, or based on a weighted average of use of funds. So if you're buying real estate and it's 200,000 and you're buying equipment and it's 200,000, half of the loan is going to have that 25-year amortization. The other half has a 10-year amortization, and it works out at a blended rate of, around 17 years. Okay. So this next slide is talking about the biggest hurdles to obtaining capital. And these aren't in any type of order as to what is the most prevalent reason for decline. But these tend to be the reasons that people have troubles with banks. We'll talk about some of them on this slide, and then the others we're going to talk about later in the presentation. So the first one, lack of business credit with banks, vendors, and or other trades. If you do not have credit in the business name, you will have difficulty getting financing at a later point. And I want to draw your attention to this because I can give you an example. I dealt with a client a few years ago. They had been in business for 20 years, always paid for everything with cash. They had assets on their balance sheet that were free and clear of debt, real estate, heavy duty equipment. They had a hard time finding a bank that would make them a loan because they did not have business credit, because they never borrowed. They always had paid for everything from cash from the time they started in business. So that was a hurdle that we had to get past to prove that they were credit worthy, because they never had credit. So if you're just starting in business, you've been in business for a while, you always want to think about having some type of small credit line or some type of, even business credit card to get your foothold in the door for obtaining credit. We're not going to talk more about that. We do have a webinar on that that's coming up in the fall, and Jairo has put a slide in there for us that talks about when those things are occurring. Another thing to think about is personal credit. Again, I put this out here because your personal credit for the SBA has to be a minimum of 640. However, most banks in the area want your credit score to be at least 680. Understand that that's after the credit pull. So a credit pull is going to be anywhere from 9 to 11 points. You need to make sure that when you're thinking about applying for credit, if you have multiple owners, this can be an uncomfortable thing to talk about, but you need to make sure everybody's credit is going to be acceptable at that level, because if there's 4 owners and 3 have good credit and the 4th one doesn't, and the 4th owner is key to the business, they may not approve your loan. Now, when it's relevant is when that owner is a 20% or more owner of the business. So if you're going to go for financing and 3 out of 4 have good credit, that might be a time to look at current ownership and see if there's a way that you can maybe structure around that, mitigate that level of ownership, at least in the short term, and find another way to compensate that other owner. Outstanding obligations to federal agencies. The SBA, in their last version of the SOP, they changed it. It used to be that if you had outstanding student loans that were delinquent, that was an absolute no. That is no longer an absolute no for the SBA. But for a lot of banks, that can still be an issue. And the thing to understand about SBA rules versus bank rules can be more stringent than the SBA. They can't be less stringent. So when you're shopping for a bank, it's just like shopping for anything else that you buy in your personal life. You want to find that bank that has the same rules that you can conform to. So that's just something to think about if you have a student loan that hasn't been paid. Other federal agency debt would include the IRS, and it would include any state or city taxes that have to be paid. Okay.
In regard to industry performance, it's fairly obvious the banks are going to be less apt to loan to an industry that's on the downside or the downswing of any particular market trends. So that's also important. As far as industry experience, this is a huge factor. You could have great credit and have everything lined up. And I'll just give 2 examples. I'll go back to Maggie's boat manufacturing experience. If you're going to try to acquire the boat manufacturer and your experience is that you've owned a boat for 20 years, but you've never worked in a manufacturing industry, the chances of you obtaining that loan go down significantly. In a startup situation, if you want to open a bakery and your rationale is because your spouse is a good cook or a good chef, that doesn't assist you unless they have worked in the restaurant industry before. And I've seen too many loans get denied because people have a dream of what they want to do, but they just don't have the experience, because the banks look at that and saying, how are they going to succeed and thrive in this particular industry if they've never been in it before?
And the next one on our slide is the uncooperative landlord. That's on here because it's happened a few times recently, where companies or people were looking for financing, and they were moving into a new location as part of their expansion, and the landlord would not sign a landlord waiver. So you need to be aware that your landlord is going to have to waive their preemptive rights to the collateral that you're putting inside their location, which is all the equipment. Not so much the leasehold improvements, because a bank isn't ever going to rip those out, but anything that will do with the business assets, receivables, inventory, equipment, the landlord is going to have to sign a waiver that recognizes the loan as being superior to them. Otherwise, if they don't sign that, they have a statutory preemptive right over the bank, and that will cause you to not get financed. Before we talk about the business plan, let's talk about some of these other ones on the other side. We're not going to talk about the ratios. So when we talk about equity injections, balance sheet leverage, working capital, or cash flow, because we're going to talk about those later when we talk about the forecast. So I will talk, though, about the collateral values or below the loan request. Again, that's why an SBA loan is a benefit to you. The one thing I will tell you about an SBA loan, and really about a conventional loan, if you are you're going into business, and what you have that you're investing in, you're spending a lot of money on research and development or other intangible assets, something that no one can touch, value, and or liquidate, and you have substantial equity in your home, the SBA will require that the bank ask for a lien on your home. So that is another thing to think about prior to going to a bank for a loan, is the equity position in your home. The other point I want to talk about is insufficient financial records or reporting. And we have a slide on this that tells you exactly what you have to have for the bank submission. But a lot of times I've talked to clients that they don't actually have QuickBooks. They don't have a formal accounting system. They sometimes manage things through their checkbook. They manage things through other ledgers. Sometimes it's handwritten. I've had clients bring me their penciled ledger records before. You do have to have financial records for an interim period. So the SBA and most banks will rely on your tax returns for year-end financials, but they also want something that's for that interim period. If you don't have QuickBooks, if you don't have something that you can put together on a P&L and a balance sheet, but you do have your records and you run everything through PayPal and you run everything through your bank account, we can help you create that financial statement to get your loan request submitted. And the last thing we are going to just touch on is the lack of a business plan. We have many webinars about how to build a business plan that will help you in your business, not only just to get a loan. I do want to put a shout out for business plans. You should always have a business plan beyond just getting a loan. The business plan is your guide. And it is something that is a living document. It should always be crafted for a minimum of a 3-year period, like a 3-year look forward. And then you should periodically, at least annually, look at that and reevaluate where are you in your business plan? How are you performing to your original assumptions? How are you performing within your industry, within your marketplace? Are you still competitive? Do your products have the same perception within the community that you initially thought they would, or that they initially had? And Michael's just changed to our next slide, which talks about a lot of this, which is the components of the business plan.
And one of the big things about a business plan is, which doesn't have to do with loans, is that if it's a document that you are just putting together for the loan process and never look at the business plan again, you're making a big mistake. It's something that should be reviewed on a quarterly basis, and if not, every 6 months, to see if you're on the right path. Because if you were passionate about it, to put it in the original business plan when you were going for the loan, it's something, to me, it's a self-report card that will help you analyze if you're heading down the right track.
So this next slide is just giving you some things to think about. These were just some recent clients that had come through. And when we talk about creating that business plan, these are some of the things that you would think about while you're creating that budget for the loan, while you're creating that forecast, right? So if I am a daycare operator and I want to have one of my selling features is I'm going to have early drop off and late pickup, then I need to make sure what my staffing levels need to be in order to handle that. And do I need to charge more? Do I need to have an extra fee for that? Does that fee cover the cost associated with having that service?
And also for the daycare, depending on the size of the structure, you need to check with local code regulations to see what is the maximum amount of children you can have. What is the maximum class size? Because if you're running your forecast off having 40 kids, but the local code will only allow you for the size of structure you have 25, that's going to be a huge hurdle for you, and you're not going to meet your financial goals.
Right. And another example is in the service business. You know, again, this is not a comprehensive list. This is just things that you should think about as you're preparing the budget. For example, if you're the pest control business that only does inside the home, and you now decided you wanted to expand and add lawn care, well, what does that do for your current scheduling? How many of those clients are you going to be able to cross-sell? What does that mean that you're going to need in terms of additional vehicles, different service technicians? These are the type of thought processes you have to go through in order to build that budget. And the next slide that we're going to show you is some of the marketing plans and the competition list and the overall strategy sessions you can have with any of the SBDC offices throughout our network, depending on where you're located. All of the consultants have skills and abilities to pull this information for you and to help you think through this process to make sure that you're getting enough of this covered in your budget to make sure you're going to be successful.
And one additional tool we have is if you're trying to acquire a business, we have a business valuation tool, because if someone's offering you the business for $150,000, hypothetically, and we run the business valuation tool based on the financial documents, and it only comes up that the business is worth $100,000, that's going to put you in a better position. And vice versa, if you're looking to sell the business, it's going to help you assess what is a fair market value price.
So as I promised you earlier, we did have a slide. We have it here for you so that you'll have this. When you are going to go to a bank for financing, if you are in business for at least 3 years, you will have to provide 3 years business tax returns. Obviously, we put in there up to, because if you've been in business less than 3 years, you only have to provide whatever you have. The interim financial statement dated within 60 days of application. I'm going to give you a little piece of advice here as a person who approved loans. You want that to be as fresh as possible to your application date. The rules for banking, whether it's an SBA loan or a conventional loan, is that they have to have a business financial statement dated within 90 days of closing. Most banks, if there's no real estate involved, take about 60 days from beginning to end, from loan underwriting to loan approval and closing, to close your loan. So if your financial statement is 60 days old at the time you submit, it's now going to be 120 days at closing. So you're going to have to provide another financial statement that's more current before they'll close that loan. If you've had a hiccup for whatever reason in that period of time, it could stall the process or maybe result in your loan not getting closed and funded. So I always encourage my clients to get that statement as close to within 30 days as possible at the point of submission, so you don't have to go back. The whole goal is to not have to go back to underwriters more than once. And I should have said when Michael was talking about the business plan, that's why a lot of times we will help you and review those business plans to make sure that we can help you anticipate any questions that the bank is going to have about your business plan, because that's really the talking point. That is your opportunity to talk to the underwriter and convince them that yours is a loan that they want to make. And so we try to help you with that process to answer as many questions as possible. And in that same vein, in the financial review, when you gather your financials together, you can provide those financials to your consultant at the SBDC. We will go through, we will do a financial review, we will benchmark it to the same type of industry data that the banks look at, and help alert you to any issues that may be there, or to point out anything that from a trend standpoint could create a concern from a bank. I just went through this with a client of mine that was doing a business acquisition, and we found all kinds of things in the financials that did not make sense, that were not expenses that needed to be there for that business purpose. So now we're going to talk about building the budget. So again, these are budget considerations. When you submit a loan for an SBA, you have to have a 24-month forecast. I talked about the business plan needing to be at least a 3-year plan, because there is part of the business plan where you will talk about future expansion plans, and that's to give a heads up to your lender, because they should be your financial partner. They should be willing to work with you as you grow your business. But what is required from the SBA is a 24-month monthly forecast. So these are some of the things that we've already kind of talked about that you need to consider when you're building that budget. Again, your equity injection, a general requirement on real estate. If it is an SBA loan, you can get by with as little as a 10% equity injection. I've sometimes had people even ask me, do I need to have the 10%? Yes, you do. And that is irrespective of loan type, because there's rules in banking under FIREA that say that you have to have at least 10% cash equity in a real estate purchase. So it can't be that you have other collateral and you want to leverage that to buy the real estate. You actually do have to have cash in that purchase. So let's talk about source of funding. Cash on deposit for your equity. When you're going to get your approval, they're going to want to make sure that you've had that cash on deposit. It doesn't have to be in the business name if you're starting up or you're doing a business acquisition, but at least has to be cash on deposit in the hands of either the business or the principals that own the business. If you don't have all of the cash for the total equity requirement that you need, there's other ways that you can get equity for the business that are totally acceptable. Gift letters is one. If you have family and friends that want to help you with this expansion or with this new venture, gift letters, there's a form. We have those forms and we can help you with that. Gifts have to be just that. There can be no plans for repayment of a gift. If you're a nonprofit, you can get grants. It's usually for nonprofits. Sometimes there are some grants that are out there for profit. Those are usually for research and development type grants. But you can go to Grant Watch and look for those. Subordinated notes and seller notes, they're almost one and the same thing. They don't have to be. A seller note means that the seller wants to sell you the business for $300,000 and they're agreeing that they'll take a note back for $50,000. So you only have to come up with $250 in that example. A seller note has to be subordinated in terms of repayment. You can pay interest, you can't pay principal. You can have other investors, other friends and family that say, I don't want to give you a gift, but I'll loan you the money, you can pay me back. Again, subordinated note, it has to be subordinated until your loan is paid off. So when you think about that, when we talk about that 7A loan, and it can do everything, real estate, working capital, et cetera, and in those instances, if they're going to lend you money, you may want to have those notes separated. You may want to have your real estate acquired in one entity and your business operation in another entity in order to facilitate how fast you can pay back some of those investors. So in building the total budget, this is just an example. I want to make sure you understand that the business acquisition, in this example, you're going to need working capital post-acquisition. You may want some additional inventory that you want post-acquisition. It's important to put all of those things into the budget to start, because if you do that, your 20% requirement in this example is that $52,000. You're going to be putting in $52,000, but you're going to get back the working capital and the funds you need for inventory. So if you include it all in a total budget, as opposed to just looking at the business acquisition and thinking you have to fund the working capital and inventory separately, you would actually be putting in $80,000 or more. Actually, $100,000 if you were not putting that in your total loan budget. An existing business, we put this slide in there just so that you know, if you're an existing business and you have sufficient other assets, it could be, if those other assets don't have liens on them or have small liens, the bank may be willing to refinance those loans in order to free up those liens to be available for that bigger loan to do financial expansion. And you wouldn't have to put cash in other than the real estate cash. So I promised I would talk quickly about the financial ratios that are required for an SBA loan and really for any loan. And so some terms we've been talking about, if you're not familiar with them, one of them is working capital. Working capital is simply the difference between near-term cash assets, so cash, accounts receivable that you know are going to be paid, and the bills that you have to pay in the same period. Okay, so if it's 30 days near liquid cash versus 30 days expenses, SBA loans want you to have at least 3 to 6 months of operating expenses in what they call working capital. Money, if you think about it like money, that's your slush fund, right? It's the money in reserve above and beyond any type of working capital or cash flow shortfall that's going to be forecasted in the budget.
Because you can't expect when you obtain a loan that the increase in revenues are going to automatically throw off enough profit to pay for the business to continue in the subsequent months. Or if you're starting up a business and you think you're going to have $10,000 a month in sales, it probably might not, you might get to that, but perhaps not in month 1, 2, 3, or 4. So you need to have working capital to fund the business for those first 4 months till you get up to the run rate that you're expected in the pro forma.
So now Michael's going to walk you through how to build a forecast. And just so you know, before he does it, these are some of the common things that you should think about when you're building the forecast, right? The biggest starting point is whether it's something you're producing or a service you're providing. How many of those can you do in a day? How many units can you produce per day, per month? what's that sales price for those units, and what's your cost. And that's kind of this starting point for the forecast.
Okay, so when you're looking to build the forecast, the most difficult thing to project is what Maggie talked about, is sales. And that's if you, and this document is applicable if you're starting up a new business, acquiring a business, or if you're expanding on your business, because the bank wants to know, I'm giving you this money, what's now going to happen to your sales? So this is a fairly user-friendly document, and I'm just going to throw in a few numbers here, and you can see that it will flood each particular cell for the first year. This is on a month-by-month basis. This number 1 here doesn't matter if it's January. What the bank wants to know is it's for 12 months. So let's just say your run rate you want to get to is 50,000. You might only hit 15,000 in the first month. You might get up to 25,000 in the second month, and then 40,000 in the third month, and then you achieve your $50,000 target in the fourth month. A mistake that people make is they'll just put 50,000 up front and assume as soon as you acquire this loan, your sales are going to go up immediately. And the bank is going to look at that and they're going to question that. Cost of goods sold is fairly basic. It's going to primarily be a percentage of your sales. So let's just say cost of goods sold is a percentage. Let's say it's at 35%. So we'll go ahead and just put a formula in there where you have a percentage of particular sales and multiply it times a percentage, and then that will take that out the entire time. Then it's fairly simple from there, because the most difficult thing to do, as Maggie just stated, is to project sales. Sometimes it could be as basic as if you're opening a bakery, or if you're adding a new machine to a manufacturing plant, is you need to project out how many more items can you produce. And if it's a bakery or a florist or anything, any other type of stuff, dry cleaner, how many units do you have to sell each day per hour based on your hours of operation, and what will be the gross profit? So then you're going to go ahead and you're going to start, putting in particular salaries for owners and salaries for all your employees, and we will put in payroll tax, which is 0.0765%, and we'll just start putting in numbers all the way across the item, the spreadsheet, and that we will use, and to go ahead and come up with what a pro forma will be. And I'm just throwing in a bunch of numbers here to try to fill this up, and look at some accounting and legal. And this is, by no means is this finished. And then what you have to also put in here, if you are obtaining an SBA loan, we put in loan repayment, and we would put in that particular number. Let's just say the loan repayment is $1,000 a month. The point of the matter is, and this is obviously very fictitious, this is showing that this business is very profitable, but the bank wants to see this, and they want to understand that if they're lending you this particular amount of money, what are they going to get in return? And then what this particular spreadsheet does, it takes it out for 3 years, because they want to see what's happening 3 years. So let's say we think that your growth is going to be at 10% and you're going to be in the 28% tax bracket. So basically what this form will do is they'll multiply every line times 10%.
Sorry about that. We had a technical difficulty here and we were disconnected. So what we were talking about is an existing business or business acquisition, and we talk about the fact that there's already a proven track record there as opposed to
startup. And that is true, and you may have historical cash flow and everything looks good from the past. Bankers have a saying that past performance is not an indication of future performance, and we get that unfortunately from our regulators. what it really means is that was the past, that was before this new debt that you're putting on the business. So that business that you're acquiring didn't have that 300,000 in debt before. So what Michael's talking about is banks like to see growth in sales, because you wouldn't add debt to your balance sheet. You wouldn't add that expense if you didn't think it was going to generate additional revenue. So banks are always looking to see what your baseline is for those first 12 months, and then they want to see growth in the subsequent periods.
It's all about return on investment. They're providing you the investment, the loan. They want to make sure you're getting a return, so you therefore have the resources to pay the loan back.
So these next slides are really for informational purposes. When we work with you on building this forecast and on building the ask that's in the business plan, and by the ask meaning the loan size, the budget, one of the things that we have to look at for you is to make sure there is a balance in leverage. So leverage is simply total liabilities on a balance sheet, because this is balance sheet leverage divided by the equity. So as Michael's forecast was showing, if you're making money from the start, usually not what happens, especially if you're in a startup or you're doing some type of big shift or big change in your business, you usually have a dip and then go back up. That impacts that equity position on your balance sheet. So the amount of money that you have to put in terms of equity for the loan and the things you're acquiring could change slightly depending on the working capital or that deficit cash flow that was shown in that forecast. I know that's a lot to absorb in a short period of time. I really do encourage all of you to sign up through our request for consultation services, and we can walk you through this one-on-one and answer as many questions. We will take questions. I know we're running a little long. We are going to take all the questions when we're done, but we can answer even more questions on a one-on-one basis. And so we put this in here for you to have from a definitional standpoint, just so you know and can absorb it and see what we're talking about. SBA requires that leverage not be greater than 9-to-1, so $9 of debt for every dollar in equity, but most banks will stop that tolerance at 6-to-1. So again, banks can be more stringent than the SBA. And this slide, the previous slide we have was on cash flow. Again, that's what the forecast will help you determine. Again, this is definitional so that you understand what we're talking about, what the banks are looking for. Generally with an SBA loan, whether it's a startup, business acquisition, or an expansion loan, within the first 12 months, you need to be at break-even cash flow by the 12th month. And usually within their tolerance level, which is the 1.25-to-1. So for every dollar of debt, in debt payments, I should say, for every dollar in debt payments, you have $1.25 in earnings by month 18.
Here's just a list of some upcoming webinars that we encourage you to sign up for and attend regarding business credit, marketing, and the business plan writing that Maggie referred to earlier.
And the additional slides that we have for you are just additional documents that you'll need to get ready in order to apply for a loan, and some additional information about the SBA terms that are there for informational purposes.
Okay, we're going to open it up for questions now. First question I received was, what was the first bank's name that you referenced to earlier in the presentation?
So for the small loans, United Midwest and Celtic Bank, they are both, you can Google both of them and they will do applications online.
All right, next question. My issue has been that my personal credit took a big hit last year. I need to know which loans for working capital are for those with low credit scores.
So depending on the bank, there are banks that will, it used to be called Axiom. Ascendus now is the new name. Ascendus will have a lower credit score. There are other funds if you're looking for small loan needs, and by small loan needs, the fund itself will go up to 500,000. Their average loan is around 27,000. So they make a lot of smaller loans, and that is a fund called the LIFT Fund, LIFT, not LYFT, like the ride share. Thank you, Michael. The LIFT Fund will also make loans irrespective of credits.
And the one thing you want to do before you apply is do everything possible, because even an extra 10 points or 20 points can make a big difference. Do everything you can do by calling credit bureaus to see what you can do to increase your score prior to going and applying or submitting a loan document.
Yeah, you can also go to sites like Credit Karma. It doesn't have to be Credit Karma, but that's just one of them. And you can run some what if scenarios. What if sometimes it's you need another credit facility. So if you can get another small credit card, that sometimes helps. If you pay down something, it can help. You can run those what if scenarios to see how to improve your score. Also, for everybody on this call, I know sometimes people are not aware, every year you can get a copy of your credit bureau score once a year directly from the bureaus, and you can look at your score and see what you can do to improve your score. It's free, and it's as long as you only do it once a year, and you can go directly to the bureaus. So that's Experian, TransUnion, or Equifax. Go directly to them and request your bureau.
Next question. How do I know if I have credit? If I have credit in my business name? Are you talking about DMB?
They do look at DMB, but really credit in your business name, again, can be that credit card that you have just to buy office supplies or whatever you need. Get it in your business name as opposed to your personal name.
And I also encourage all businesses to get a business credit card in their name, not only for the reason Maggie just stated, but when working to do your taxes with your accountant at the end of the year, it makes it a lot easier and simpler for them to conduct your and put together your taxes.
Next question. If you're a startup or buying a business, I'm assuming you're not expected to have business credit. Is that correct?
If you're a startup, that's correct. You would not have business credit. If it's a business acquisition, the business will have potentially, depending on the type of industry, could have trade credit, right? And that trade credit is one of the things when you're talking to the seller, is getting access to those same suppliers to make sure you don't have an interruption in getting that lined up before you submit to the bank.
I have federal student loans. Can I qualify to get an SBA loan?
If you have federal student loans, of course, yes, you can qualify to get an SBA loan. If you have an existing SBA loan, you can get an additional SBA loan. If you have a disaster loan, you can get an SBA loan. You cannot, historically, if you were in default on a student loan, it was an automatic no, you were not eligible to submit. They have since separated the student loan aspect from the business loan.
When you look at a person's background, what type of things do they look for? Do they look at criminal history?
They do look at criminal history. So I'm glad whoever brought this question up. They look, when you go to, you've now completed the business plan, you have your forecast done, we're ready, and there's a slew of SBA forms that have to get completed. Not that many, there's about 4. One of them is a form 1919, which is the application eligibility form. And in that form, it's going to ask you questions about bankruptcy, and it's going to ask about lawsuits or any convictions. There's a section on that form that talks about the business, which is the first section of the form, and then the second section of the form are any of the principals. And each principal has to fill out their own respective section. They will also pull, if your loan is approved, as part of the approval process, they pull what's called a LexisNexis report. And that LexisNexis report will pull up everything. Just because you have something in your past does not mean you won't be eligible for the loan. So I don't want to discourage anybody. There is an additional process involved. depending on the circumstances, which could include fingerprinting and some additional steps in order for the SBA to make that determination. At that point, if it's a felony charge as opposed to a misdemeanor, and even if it's a misdemeanor, those decisions are really the SBA decisions. They're not the bank decision. The bank defers that to the SBA, who makes the final decision.
In many situations, I'm asked to submit proof of start contribution. The issue sometimes is that I just acquired items as I started. I was working a full-time job, so I bought items at different times from the day I actually established an LLC. I would submit a letter explaining this and a small contribution from family of less than $1,000. As someone that has approved loans, please advise how to address this.
So usually with, and that's a great question about things that you've acquired along the way. The thing I would tell you is always keep receipts. So if you have receipts that show you have the assets, if you have a listing of assets, if it's a listing of assets that is going to be readily used in the business, one that comes to mind that happens all the time are chiropractors that come out of Palmer. They usually have the table because they bought it when they were in school. If you can show the assets, oftentimes you'll get credit for it. With the gift, but receipts are more important. So anything you spend money on, keep a receipt, keep that credit card receipt. I used to tell clients to get a folder and just throw it in the folder until you're ready to apply. So we can use all that for equity. As it pertains to money from family, again, those are gift letters. So if that family member has given you that, a gift is totally appropriate to be used as equity. It just has to be documented through a letter that shows that they have no expectation for you to repay that money. Borrowed money is not equity. So like when we talked about your home before, and I said your home could be used as collateral. What I'm telling you is borrowed money is not equity. So you cannot borrow on your home equity for your equity at the time of application. And without skirting any rules, I will tell you that you have to have money in your account for 60 days. Okay?
What are the requirements for a service industry?
It would be the pro forma document if you're speaking of a service industry like a dry cleaner or a florist or a restaurant. It would be sales. It would be your cost of goods sold. It would be everything that we put on the pro forma document, notwithstanding all the SBA documents that are required. But it'd be fairly accurate. It would be a review of the competition in the area. It would also include your experience, as we stated before.
Yeah, I know there is some misconception sometimes. So I don't know if this was the question. I've heard that there is a misconception that banks don't want to lend money to service-based industries because they don't have as much collateral that's tangible maybe as like a manufacturer by comparison. And whereas I might say, yes, that is true, the collateral isn't there. That's what the SBA program is there for. And if you have a long-standing time in business as a service business, you don't necessarily have to be an SBA loan either. You can get a conventional loan, but you have to have a track record, right? You have to have that track record of success. There's also been misconceptions that I've heard over the years that banks don't like to make loans to sole proprietors. They really just like corporations or S corps, LLCs, partnerships, and that is equally not true. Banks will make loans to sole proprietors all day long. The issue is, do you have a business plan that provides reassurance to the bank that your loan is the loan that is going to be safe for them? Because banks lend out their depositors' funds. Banks don't have separate funds that they lend out. They lend out their depositors' funds. And so their goal is to get back those funds.
And that goes back to the business plan and why it's so important and the story that you tell along with that particular business plan.
Next question, how do we get assistance from the SBDC for creating an accurate budget forecast, forecasting using my QuickBooks Online?
I would just contact any local SBDC office that's in your particular area, and all the consultants have the skills to be able to assist with that. And in the unlikely event there isn't, there's multiple resources and multiple consultants throughout the SBDC who can assist you with that.
Yeah, for more information regarding how to get services from our SBDC or local area, please visit www.sbdcorlando.com/consulting. Fill out the request for consulting form there, and you should be able to be connected with one of our consultants in our area. Okay, next question. Okay, what are the local banks for small business loans?
So again, pre-COVID, everybody was lending. And pre-COVID, everybody was getting a little nervous because the economy was so strong that, you know, bankers sometimes are a little pessimistic, and we're always waiting for the other shoe to drop. So at that point, they got a little tougher and started looking for that direct industry experience. They started looking for the, you know, solid down payments. All the banks out there are lending in various levels. So the large national banks, Chase, Wells, B of A, are lending. The local community banks are lending. Truist is a big lender. They're a regional bank. Center State Bank, Seacoast on the Central Florida and East Coast area, Centennial Bank. These are all banks that are lending. And if I neglected a bank, it wasn't to be disparaging. There's a lot that are lending. One of the benefits that you have when you work with us is we do spend a lot of time cultivating relationships with these banks. When you're working with us with a business plan, or you're working with us with a forecast, when we get nearer to the end, when you're getting ready to submit, if you don't feel that the bank that you're with currently is going to be receptive to either your new loan, if you're an expanding business, or even from an acquisition standpoint or a startup, we will call bankers that we know and see who is lending for your particular industry in your particular area. Banks reevaluate their portfolio risk every 90 days. And so and I'm just going to pick on restaurants, and I'm not saying anybody's not making restaurant loans, but say today they say, I don't want to make any more restaurant loans. Well, within 6 months, they may be fine making restaurant loans. It's all about how they have a concentration within their loan portfolio of different types of loans and how they try to diversify that. So it's constantly changing, constantly evolving. That's part of what we do, is try to keep in touch with everybody to make sure that we can find a place for you guys, that we will have a successful process and get the loan.
Next question, how do you search for the lower credit score of banks, or banks, I guess, that are favorable to lower credit score?
A lot of times the banks don't put their credit scores. They don't advertise that information. We tend to know what they are. So my comment about something like that is, if you see my information or Michael's information on the email, if you just have a one-off question like that, just shoot us a quick email about the situation, and we'll try to find you the right place to work.
We are a business that has about 6 years of revenues, but we've had a hard time securing business loans from traditional banks. Is an SBA loan a better option for working capital loans?
I think so.
Yes,
I think
yes.
so.
Because what happens is, and I'll go back to the comment I made before about lines of credit. So it tends to be that people will go in and apply, and they'll be looking for a line of credit because they're wanting to do something, right? I need to get a new product line started. I need to hire salespeople. I need to do whatever. Banks look at funding based on your purpose. So if your purpose for the loan is something that's going to pay off over the longer term, they want you to have a term loan. the SBA working capital term loan is the best program out there because it allows you to repay that loan back over a 10-year period. If you were to get just a conventional loan, now you're talking about a 3-year repayment. Well, if the investment you're making today is going to take a while to pay off, that may be too stringent to make it work from a cash flow standpoint. When the bank looks at it for an SBA loan, some of your other business loans that are on your balance sheet, they may be able to also include those as part of the refinance and stretch those out as well and give your business more breathing room in order to grow and succeed. Just as a side note, if your bank, wherever you're banking today, they can't refinance their debt with an SBA loan. So if you have a loan and you have a 3-year repayment on it, that bank can't refinance itself and give you a 10-year term. You do have to go to another lender who would be able to look at it and see if that debt is eligible to be refinanced over a longer period, as well as creating your funding your additional needs.
Are there any special requirements or benefits concerning SBA loans for 100% disabled U.S. veterans?
There really aren't, though I would tell you that all banks are incentivized at this point to make loans to disabled veterans. So there are grants out there that are available for disabled veterans. There are government contracts that you may get because of disabled veteran status. But with the SBA program, it's really kind of a blind program as far as nobody looks at the makeup of the person. It's really, what is the business plan and how can you succeed?
Are there SBA loans for corporate leasing?
No.
I don't think so.
How many loans can a business owner anticipate borrowing for a startup?
So for a startup, you really want to have that initial loan that would cover all of your needs for that first 24-month period. If you get an SBA 7A loan, and it's a 10-year repayment, you can prepay these loans. Typically, they don't like you to prepay more than 20% per year, because even though the loan it's a variable rate loan, meaning it changes when prime changes, most banks fix it for a 5-year period, and that's why they like you to stick with that 20% per year. But there isn't a prepayment penalty. Usually after you've gone past that first 2 years and you're no longer deemed a startup in the world of banking and the world of SBA, then usually that's at that point you're looking to get a line of credit or some other type facility to help grow your business.
And when you do make that initial loan for your startup, please make sure you get enough to cover your working capital, because if not, the failure rate increases quite a bit if you don't account for that working capital.
Is there a way to find additional funding for startups?
Okay.
Other than friends and family.
Oh, you mean beyond, outside of the SBA loans?
Yeah.
Kickstarter campaigns, I will tell you, I can give you a couple of examples. I helped a gym relocate, and when they did, it wasn't a complete startup, but it was a restart because they had significant client attrition when they had to move from one location to another. And this was actually during COVID, and it was a gym. So they pre-sold memberships. So depending on your business, and that's one of those things you can discuss with a consultant, and they can see if there's other ways that people have been creative. I also know of a business. He was a credit analyst that worked for me at one time in banking, and he got out of banking, and he owns a brew pub and dog venue. So you can bring your dog. It's a doggy daycare that also has a brew pub and a coffee service that has, Primo coffee. It's actually in Jacksonville, and they did it because they were able to sell memberships, because membership has privileges in their business, and they were able to generate funds to get started for that. that money, you have to be careful when you do things like that, right? You can't use that money for tenant improvements or for other things, because you do need to get open, because these people have given you money on the presumption that you're going to open, and they will be able to utilize those services. So you can use it for working capital after you open, because it's basically pre-sales. But you can't use it for other things like equipment or tenant improvements.
If the goal is to buy multiple businesses, is it suggested to buy one business and operate it for 2 years before acquiring additional businesses?
Yes.
Yes.
Yes, I will tell you. I'm sorry to cut you off, Ivor. But whether it's, if you're an existing business and you want to do what we call vertical integration, so like that pest company that I talked about that was doing lawn care, his next plan after that was to add irrigation services as, additional cross sells that he could build his business, because he's trying to grow his business to a point that he'll have a great exit strategy and be able to sell it at a later date. It's an estate planning process. The goal is to absorb, right? So he has a business, it has strong cash flow. He acquired the one business, he has to absorb that, build that strong cash flow to where everything globally between the two companies is now at par, and then you add that third business. Because every time you add something, you do take a little dip down, and then you go back. So you want to do it in succession.
Being a service business requesting a loan, even with a loan track record, has been very challenging. Are there any tips for presenting good services business to lenders?
I will tell you, it's oftentimes all in the business plan. So for the person that submitted that question, I encourage you to fill out a request for consultation. Let us take a look at your business plan. Make sure that it's being presented in a way that is going to address all of the lender's concerns and turn that no into a yes.
And there is that business plan webinar that's coming up that we is in one of the slides that we strongly encourage you to attend as well.
Okay. One last question and we're wrapping it up. What is the SBA Veterans Advantage Program for?
The Veterans Advantage Program is designed to help you find a lender that is beneficial to getting you funded. Again, maybe I'm just pro banker, but I would tell you all banks are geared to helping veterans get their businesses up and running.
All right, that is it for today. Thank you all for attending our webinar on accessing capital. If you have any more questions, please feel free to email Maggie or Michael, or also, actually, I urge you to fill out a request for consulting form. There you could be connected with a number of people who are able to assist you with your SBA loan financing needs. Visit our website, www.sbdcorlando.com/consulting to fill that request for consulting form. Also, as a reminder, we're going to email out an evaluation form. Please fill that out. That gives us an idea of how well we did and what we can do in the future to better serve you.
Can I just say, and I want to say, I thank all of you for sticking with us. I know we ran a little long. The subject is so important to get you on the right footing. And we did have, the little limited time that we had available for it. So as Jairo said, please fill out that form so that we can provide some assistance for you. It's the only thing, the way that the SBDC survives and is here to help businesses like yours in order to gain access to capital is we have to have those RFC forms that we can say, yes, this is a legitimate business owner, or this is a legitimate person that is needing our services. And that's how we stay funded in order to be here to help provide all of these services to you at no cost. There is no cost for our business plans, no cost for our forecast, no cost for any of the services we provide. We just need you to complete that form.
And I want to echo Maggie's thoughts and thank everyone for hanging in there with us, and do apologize for the technical glitch, and we do hope this was extremely helpful for you. And there's a lot of our colleagues around who can assist you with any of your needs.
All right, thank you. Have a good rest of your night.